So welcome along everybody to today's webinar, 6-member self-managed superannuation funds, the good, the bad and the indifferent. Look, so in coming up with a title, I actually started doing this presentation on 6-member funds a couple of years ago, and at that point in time I was calling it the good, the bad and the ugly. And I think it's actually more of an indifferent presentation more than a good and the bad, and kind of as we work through it, what I really want to talk through is, I guess, all the critical issues that we see from both a technical point of view, but also from an administrative point of view in regards to this this area. So you know, what I'll be focusing on a little bit today is issues along the lines of the compliance issues like that, but also I want to touch on how we got here, and then all of the various considerations that I've certainly had a bit of a ponder through. But I find it a really interesting area because myself and certainly others within the industry that I listen to speaking on this, I guess we had a very indifferent approach to the whole concept of 6-member self-managed super funds when it was first announced. But clearly in the time since the legislation passed, and it's not really all that long ago, right up until now, the interest that it's generated is certainly more significant than I thought it would be. So it's certainly an area that, whilst the focus of the conversation piece is around 6-member self-managed superannuation funds, I think ultimately what we need to be mindful of is really what we're talking about is expanding beyond the traditional definition or the traditional setup arrangement of the sole member or the dual member couple, and whether we're going to expand the fund membership. So touch a little bit about how we got here, what those considerations that I've been alluding to initially, what those are, and I suspect there are many more as well. So, you know, I've pondered it for a while now, but I suspect there are going to be a lot of other considerations as well that people have thought about. And so ultimately what I want people to obtain from this session is the impact that the change has on SIS from a compliance point of view, but also by extension the Tax Act, with a specific focus on self-managed super. Obviously, you know, as much as this expands beyond small APRA funds, and I will touch on small APRA a little bit through the presentation, you know, I really want to focus or drill down on the SMSF elements for us. The trustee and the decision-making powers of the trustees, I think this is probably one of the real key issues of this whole 6-member super fund scenario, or the extension of membership inside the self-managed super fund scenario, because it really prompts us, if we're not already prompted enough to review trustees in this space, then certainly trustee powers, one, the capacity to meet the definition or the new definition is another thing, but then also what ongoing control mechanisms are in place for trustees when you are entertaining having multiple trustees and potentially multiple generations inside the fund. I think all of those issues become fairly relevant for us to work through. So that's effectively what I'm going to get through or go through, and that will line up with the key factors that should be influencing the decision in regards to self-managed superannuation funds. So, you know, 6, is it a good number or not? How did we get to 6? For those of us that have been in the industry for a long enough time, we'll basically know that 4 was a relatively arbitrary number anyhow, from a selection process, and the debate for years has been, you know, what is the right number of funds? You know, 6, 8, 10. Where do you stop? Where do you start? And so, you know, when we came up with, or not when we came up, but when Treasury came up with the idea of expanding to 6-member funds, you know, I guess the end response there is a little bit like, well, you know, 4 was ultimately based on the concept of around the family unit, particularly when the SMSF definition was amended in that 99-2000 period from the excluded funds, you know, and there was an initial focus on family SMSFs, and I think largely that's where we're seeing a direction or a change in direction for these funds, and particularly if we're looking at expanding membership, we're really moving away from what I would consider what I would define as associate-based funds and into that sort of family fund space, which ultimately, if you do go back 20 odd years, was the primary intention and the initial definition of self-managed before they maintained it as the same as excluded funds with capacity to add members. So, you know, whether it's a good number or not is probably in itself, again, a little bit indifferent. And we will see, you know, funds again that have more than 6 family members and now feel aggrieved by this sort of number. But as we work through the various issues associated with it, then that's what we've got to sort of address is, okay, well, regardless of the number, you've got to contemplate all of these other sorts of issues. So, you know, how did we get here? And I think the easy answer, or I guess the answer I provide often from a presentation point of view, is it was a little bit of you know, toing and froing between government and opposition prior to the previous federal election, where one of the measures that was obviously being touted was the removal of excess franking credits, and so almost a return to the very early 2000s, where anything excess was just effectively lost. So you had your credits up to your tax liability, and then beyond that, you didn't receive them. Then, of course, we got into this world where self-managed super funds, particularly retirees, were able to benefit from the excess franking credits. And that in itself, you know, drove a lot of our retirement income strategies and pension payment requirements and other issues. So, you know, the introduction of loss of franking credit refunds, one was often, I think, overstated as to the amount of benefit people were getting from franking credits, particularly once we saw transfer balance cap introduced and retirement incomes therefore reduced. So, you know, in many respects, the enhancement or the increase to 6 was viewed by industry as a bit of a transaction to go up against the franking credit refund issue. It wasn't necessarily an area that the industry itself was screaming out for at the time, which meant it for a lot of us, it took us by surprise. I mean, there's clearly been other issues that are now being addressed by the government, which have been on our radar for a lot longer, and good to see those measures like residency, legacy pensions, and that being addressed. But this was a nice measure. Ultimately, at the end of the day, it's a nice measure. What we got in 2019 wasn't a great deal. We got a little bit, and then we got it removed prior to the election, and they did that in order to pass some craft beer legislation, which, you know, for people like myself who enjoy craft beer, I'm all for beer legislation over super legislation. But we revisited it. So we got back to the point where post-federal election, the government reintroduced it as a measure. We had the legislation introduced in September 2020. It went to a Senate committee, and that Senate committee effectively accepted the proposal with a couple of dissenting members from the opposition, but largely they supported the measures. And so we finally got to the point of royal assent on the 22nd of June this year. And of course, the way that the legislation was worded from a point of view of commencement, ultimately the measures came into effect from the 1st of July 2021. So here we are now, and as most of you will know, the tax office, despite having 2 years up their sleeve from an initial introduction to potentially prepare the systems to integrate the changes, the system wasn't ready on 1 July, but now at least people can that do electronic registrations for their self-managed super funds, they can now have up to that 6 members added at original establishment phase. So we had a period of probably about 5 or 6 weeks where people had to do one process for the first 4 members and then a change of detail manual form. But that's all been solved, and now we've got a system with the tax office where we can set up a self-managed super fund for 6 members. So we finally got there, 2021, and so this is the new way forward for our self-managed funds. So from a brief overview of some of the key issues before dealing with the practicalities of this whole space, there were really 5 significant areas that came out of the legislative update. There were over 40 reference changes, so legislative changes that impact quite largely small APRA funds or largely APRA funds and their reporting requirements. So I'm not going to focus too much on those, but in many respects, the other areas which I will focus on were very specific to self-managed super fund. But clearly the big one was the change in our definition under 17A. And of course, the key to that was we've now got a new definition which says no more than 6 members, which is far better wording. Call me pedantic in this issue, but far better wording than fewer than 5, which, fewer than 5 was, it's obvious, clearly it's obvious what fewer than 5 means, but just by putting a number that wasn't 4 would often lead to questions for the those that hadn't received any level of education in regards to this space. So this is our new definition. It's set in concrete now in 17A. Interestingly, I do follow a lot of the online versions of the legislation as they sit, and the legislation's probably only been updated itself in the last couple of weeks. It took a while for all of those changes to come through, but on reflection prior to the presentation, everything is well and truly entrenched in all of the various pieces of law. The flow on, of course, from the self-managed super fund definition, the obvious one is the Income Tax Act, and we've got our definition changed there for small superannuation funds, which is a fund with no more than 6 members. So again, that Income Tax Assessment Act definition is vital because there's references, which I'll touch on in a moment, that allude to small superannuation funds within the Tax Act, and so we need to know that definition lines up with the self-managed super fund definition. Less relevant, but still an important point was obviously that the Corporations Act also defined small APRA funds to be the no more than 6 members as well. So that was a big change there. And the SIS and tax section references, which were in and amongst those over 40 changes, and I'll highlight the key measures of that in a moment. But of course, probably the most significant for super or for self-managed super beyond the definition change was the financial statement signing requirements. So section 35B, which provides us with our key issues, we used to have a prior rule prior where it said if you had more than 2 members of the fund or more than 2 individual trustees or directors, then at least 2 of them had to sign. Now, in effect, which basically meant, because if you had 3 or 4, it meant at least 50% had to sign. Because we've now got up to 6, we've got that rule, which in essence mirrors the previous requirement, but tightens it up, given that 2 wouldn't be enough for a 5 or a 6 member fund to meet that 50% requirement. So if we've got 1 or 2 members and you've got individual trustees, and all trustees must sign. If you've got 1 or 2 members and a corporate trustee, then all directors must sign. Of course, if you've got sole director, just the one's required. But if you've got 3 or more members, then at least half of the trustees have to sign. So ultimately, you've got that requirement of 2 signatures for anything up to 4 members, and then you've got the requirement to have at least 3 people signing once you go to your 5 and 6 member self-managed superannuation funds. So it's not ultimately that different to what the legislative requirements were before. But I guess one of the key points to identify in this piece of legislation is this is talking exclusively about the financial statement. So your statement of financial position, your profit and loss statement, balance sheet, effectively, for the super fund. So other requirements, other signing requirements are still a little bit, I guess, subjective to audit requirements. So I think it's an important conversation piece to have with your fund auditors with regards to signatory requirements and other things for funds, because as we know, a lot of trustee resolutions can be accepted with just the chairperson's signature. So they don't necessarily, there's nothing that mandates that everybody has to sign the documents. But things like the audit engagement letter, the trustee representation letter, when we've had conversations with various auditors, they're still wanting in that initial communication to get the acknowledgement from all the trustees. So, I think that's a procedural element that people need to be mindful of, that this is a good time for the 21-22 year onwards, and I know we're some way away from that audit process. So this is a good time to start that communication process with fund auditors to make sure that moving beyond or into the lodgement period for this current financial year, that you're meeting the obligations and not holding up the audit processes as such. So I guess just a first practical point there is it's always a good touch point to communicate with the fund auditor on what they might require from the various levels of documentation. But certainly from a signing point of view in the financials, we're looking for that 2 or 3, subject to the number of funds, or of course 1 if it's a sole director company. So the legislative references, for me, the key legislative references that deal with this, and I'm not necessarily going to work through these to any significant level, but I guess it's just a matter of identifying that the definitional change obviously had flow-on effects to certain elements, and probably the most important one being the acquisition rules, where it specified that small superannuation funds in essence were the only funds that could acquire business real property from a related party, and therefore, and also the in-house asset exception. So it's important just, I guess, to create the bigger, broader picture for everybody about the key issues of what this definition change means. Now, one of those or 2 of those key issues from the Tax Act are driven heavily by limited recourse borrowing arrangements, and the quirky scenario of where you had a limited recourse borrowing arrangement in a retirement phase interest, and you're paying out the benefits from an accumulation interest. Well, that would effectively enhance your capacity to have money in retirement phase, so it would create a transfer balance credit the repayments of those amounts. Again, few and far between who that actually exists for, but it's just one to be mindful of. And similarly, the total super balance with limited recourse borrowing arrangements. If you've got a limited recourse borrowing arrangement with related party lenders that you entered into after, I think it's 1 July 2018, it might be 2019 off the top of my head, but any LRBA entered into with a related party after that point in time will count proportionately against the individual's total superannuation balance. And of course, once somebody has met a condition of release, regardless of who the lender is, for those same LRBAs that start after that time, then it will count proportionally towards their total super balance. And then the last sort of tax one is the disregarded small fund assets, which of course is getting a fair bit of attention for other reasons at the moment around the ECPI and the inequity between the segregation rules and the transfer balance, or the general transfer balance cap. But clearly the disregarded small fund asset rules do relate specifically to small superannuation funds and impact what we do in that segregation space. So the 4 key ones, as I said, for the SIS regulatory point of view, really come around the in-house asset rules and the business real property definition and acquisition exceptions. So largely what we're addressing is just making sure that all of those on-flow legislative provisions around in-house assets and that say the same thing as the SMSF definition. So they give us that capacity to acquire business real property from a fund if we've got up to 6 members. So again, you have to make that change, because you've got an SMSF that was set up with 6 members, and you've got the business real property exception still sitting there saying fewer than 5, then any fund with the larger balance is not going, the larger member number are not going to be able to utilise that exception to the rules. So that whole concept there, the definition of a Part 8 associate, it's just all about tightening up the legislative requirements to meet their ongoing compliance issues. So key areas, but of course the real crux for it comes down to the benefits and the issues associated with having 6 members or more in a self-managed superannuation fund. So what I want to work through for the remainder of the presentation is the key issues that I see from an administrative point of view, but also from I guess an advice piece, and even from a trustee education piece. The key areas that I've broken down into our establishment and fund administration, then the investment side of things, and then the benefit payment part of the SMSF life cycle as well, because all of these areas are somewhat I guess, up for debate from a question mark point of view as to how significant they're going to be. And so I think it's important, really, from a conversation piece, that we're identifying with any prospective client or current clients who are looking at changing their situations, that the whole concept of a 6-member self-managed super fund, you could argue that the benefits that it's going to provide for anybody are largely benefits that are fulfilling benefits, because to suggest that a self-managed super fund with 6 members is going to be cheaper than say an industry fund is just not a true statement. It might be true in a certain set of circumstances, but it's a matter of identifying the specifics as they apply to each set of circumstances to determine whether or not it's in somebody's best interest to look at the concept of having a self-managed superannuation fund. And what we know and what we've seen over the last few years is that whole best interest duty can often be raised as a negative in the SMSF space with regards to reviewing alternative options for prospective SMSF clients. So if I look at the priorities from an establishment, or sorry, the positives from an establishment and administrative point of view, then clearly the first positive is that it does cater for those larger families. So despite the laws of averages and the records of families in Australia, and I guess we'll get a little bit clearer picture of that as a result of the census that we've all participated in a couple of weeks ago. But it gives us that capacity to say, okay, well, we've got more than, we've got partners, and then you've got children of partners. And so if we've got more than 4, we don't have to choose who our favourite is anymore. Now, that was always sort of the ongoing sort of throwaway line in the old days of talking about 4-member self-managed super funds, but it's obviously a relevant situation to contemplate here. And if we go back to the image that I placed up on the screen earlier of a former family from the United States, where the lovely lady met the lovely fellow, and they ended up bringing 3 children into the arrangement each. Well, of course, that's not going to satisfy the SMSF definition either. And so, there will still be, in certain circumstances, that need to make decisions. And I think probably for me, one of the significant conversation pieces that I'm hearing around this space is we start to hear a little bit more about the concept that I touched on in the introduction, which is the concept of the family superannuation fund, which is a direct sort of leftover piece from the original SMSF definition. And then the family super fund, takes that one step further to the concept of the bloodline superannuation fund as well. And so we see all these initiatives being promoted within the industry, and they all have their benefits associated with them, largely around estate planning issues and things. But again, I think we need to be mindful that when we're talking about even estate planning, that there's only so much we can still do in the superannuation space. And so often it can actually be about asset protection and the like there, rather than the estate planning side of things, to keep things down the bloodline. But also, there's no guarantee, obviously, that that bloodline is a great way to go, because we've been riddled, or we've seen plenty of examples from an estate planning point of view of funds that have had problems based purely on bloodline. So, key issue to be mindful of. Clearly, the whole 6-member fund or multiple member fund just strengthens the whole argument for a corporate trustee. And even to the point where, if you look through the explanatory memorandum to the legislation, the Treasury identified that there are some restrictions, state-based restrictions to trustee acts, that are going to limit how many individual trustees you can have in certain circumstances. And so, it just puts greater weight on the trustee side of things. And I guess a collective conversation piece around that whole trusteeship side of it, and I'll mention it again from the investment side in a moment, but it's really that whole asset management. Now, any of you that have done SMSF administration will appreciate that changing bank accounts, changing broker accounts changing the investments for individual trustees is a complex, drawn out, frustrating process. Now, it should be or could be relatively simple if all the parties associated with the process sort of understood what was going on and simplified things for everybody. But that just hasn't been the case for the last 20 plus years. So I can't necessarily see it changing soon, which then gives greater precedence to that corporate trustee setup right from the get-go. So albeit incur those additional costs up front, but for longer term gain of not having those frustrations, be they time frustrations, potential cost frustrations, or anything else associated with individual trustees and changing fund details. And I know myself, I set up my own self-managed super fund over 10 years ago now, and I set it up with individual trustees. And then I felt, it was probably a bad thing to be going out there and promoting corporate trustees to people when I had individuals myself. And so I went through the process of changing from individual to corporate. And that was in itself very painful, even to the extent that, I was told that by one of the banks that it was easier just to open up a new account and open up a new broker account, albeit then they changed my original accounts to the corporate trustee anyhow. So I ultimately set up new accounts without any absolute need to do it. So, the whole concept of identifying and dealing with the right people in any of these sorts of equations is fairly important. The reduced costs. Now, that's one of those areas I always have talked about costs in a positive and a negative light with self-managed superannuation funds. And I'm going to draw upon the ATO stats in a moment to touch on it. But what we've got to understand is reduced costs can sit on either side of the equation. And it often comes down to things like, the investment structure of the fund, asset segregation, the number of portfolios, and all those other sorts of things that multi-generational or sibling-based funds introduce to self-managed super. So reduced cost is not necessarily always going to be a positive or always going to be obtainable. I think the Australian super fund definition clearly for the next 12 months is an absolute pro, because we often look at the concept of it might be the retiring couple and they look to travel overseas. Now, of course, that's not something that many of us have been able to engage in for coming up to 2 years, and we hope to look to be able to do that again in the near future. But the concept of expanding the self-managed super fund to meet that definition of the Australian super fund, where we will still have the central management and control requirements. Well, what it means is that if we've got children, I see this as being a real positive, where there might be children who go to look to work overseas, and by joining in with their parents' fund as an example, well, right now we know that that's problematic, because if the parents are in retirement phase and the children are in an accumulation phase, then we're going to fail the active member test, because greater than 50% of the active assets belongs to non-resident members. But come 2022-23, if we see the changes to the Australian super fund definition, then we're going to be able to satisfy the central management and control test, because the parents might have been away, come back, done all of that, and just enjoying their retirement, maybe as grey nomads travelling around Australia. But the children might be looking to work overseas, and there's not going to be any prohibition on their capacity to contribute. And I think that's a huge positive, because then they know where their fund is being managed, and they can still be involved in the decision-making process with their parents on that 50-50 concept. So I think there are certainly benefits in that space. On the negative side of things, and again, the balance between positive and negative is relatively marginal in a lot of these things, is the trustee provisions. Now, the trustee provisions we'll touch on a little bit again when I talk about benefit payments towards the end of the presentation. But I've seen, just on fund establishment point of view, in the last 12 months, or probably 2 years since the original legislation was introduced, there are trust deeds out there that ultimately regurgitate the legislation from a definitional point of view of what is a self-managed superannuation fund. And so they put restrictions on how many people can be in those funds. So, we often get a little bit tired of the lawyers screaming to check your deeds and all those sorts of things. But if we're looking at adding members in, then it's absolutely paramount that we check the fund's deed to ensure that it provides for a fund to be in accordance with the definition of a self-managed super fund without actually defining that within the deed and therefore restricting the numbers. And I've seen deeds recently that effectively were written around that 2019 and beyond simpler super sort of, or whatever it was called back in 2017, who knows these days. But that sort of time frame where the deed sort of stipulated that a self-managed super fund is currently a fund with fewer than 5 members. However, should the definition change, that the deed would actually provide for it. So it was written into the notes of the deed. So, we've seen a practical application being applied by numerous deed providers over the last few years. But it's important, if you've got particularly those older funds, it's important to make sure that if they're looking to bring children in, that their deed will actually provide for it. As I said, the individual trustees, that is a key issue. One, because of the administrative side of things. Once you get beyond 2 and you're having to look from a signing requirements point of view, particularly if you're going up to 3, 4, 5, the signing requirements, location of each of the trustees. Do people change their names? Do we add and remove members as family members pass away or join the fund? So all of those things associated with individual trustees, are somewhat problematic in the larger, but also administrative restrictions. So we know that if you open up a broker account, the number of characters is often restricted as well. So it just makes it difficult from a separation of assets point of view to be absolutely comfortable that your fund is saying things in the right space or in the right way. And then reduced efficiencies, and that comes a little bit down to that whole location concept. So it's, I talk about the positives of the Australian super fund definition and the ability for people overseas in the future to potentially contribute to the fund whilst they're away and not a resident. Well, then, what reduced efficiencies do you have associated with people traveling, and what sort of travel are they doing? Are they in a permanent employment position overseas, or in a relatively permanent position where they're in a stable location, or are they traveling beyond? Are they on their gap year, which has been extended? They're over 18, so all of a sudden they've become trustee of the fund, and they're traveling around, so we don't have access to their location as easily as we want. And I think that's a key issue, and it kind of leads into the conversation piece around investments and the decision-making process. And so I'll touch on it a little bit there. But, if we're talking about adding children to the fund, well, what we've got to appreciate now is remove ourselves from, certainly back in my day, where you left post age 18 in some form of, and looking for early employment if they haven't already had a job to work through school. And so if we're looking at adding them to the self-managed super fund, then they've got all those trustee responsibilities right from the get-go. And I think that's a little bit different to the concept where we probably first started thinking about adding children to the fund. We contemplate adding them prior to age 18, and what's the associated benefit of that. So, all of those sorts of issues lead into the control concept, which I will come back to and revisit from an estate planning point of view. But again, referring to the deed, what are your appointment and removal requirements? What are all the things associated with when you're trying to add people to a self-managed superannuation fund? So if I look at some of the benefits and impediments, just to sort of flow on from those points that I added there, I think the permanency and portability is a key point to be mindful of. And portability has always been one of those conversation pieces right since sort of super and super guarantee were introduced, where we had member choice in its first iteration. We had portability back then as well, and these things have evolved over time, and choice has evolved, and now we've got Your Future, Your Super, which is going to introduce stapled super from 1 November this year. Now, the reality of stapled super is it's effectively the pre-default super default if no choices is given. So if we've got situations where an employee starts up with their new employer and their first port of call is to do superannuation choice, well, they can choose a self-managed superannuation fund if they've got a well-established fund. Now, if we've got a new employee in, or from 1 November, if they don't provide a choice, then there's going to be an onus on the employer to go and have a look to see if they've got a stapled super fund and then make contributions into that fund. And only then, if they don't have a stapled fund, then they can invoke their default super. Now, to suggest that a self-managed super fund is a great stapled super fund option would certainly be overselling the concept. But if we start to think about and start to address issues like administration fees and engagement, and that's probably leads into my next point quite nicely. Financial literacy is a huge issue, and I use my son a lot in these presentations and in general conversations. So he's doing year 12 at the moment. He's 18 years old. He's bright. I'm going to say he's a bright lad, but not in every sense of the word. I mean, I wouldn't say necessarily that he's financially bright. But he wants to be. And so, the capacity, we've spoken about the whole idea that they don't talk through a lot of these issues. They don't talk about superannuation and other financial restraints when you're going through school so much. And it's clearly an area that needs to be addressed a little bit more, is that whole financial literacy thing through the education system. Now, that's not for me to talk about throughout this presentation, but it's clearly an issue, because if we want to get these kids engaged in, say, our own funds and in the decision-making process, then that's where the stapled super opportunity can be beneficial, because you can sort of teach them along the way about their trustee obligations. Then potentially they can make that decision, whether it's right or wrong for them. And that engagement then goes even further to the point where they're a little bit more involved in the estate planning side of things. Now, again, that can have its good and bad implications. And one of the things that I would address when talking about that, I'll touch on a little bit later in the presentation, but that is, again, the key, that adding more members to the fund doesn't make estate planning simpler. It may just at least get that engagement concept. So you're talking about what strategies can we introduce if we want to flow money through to the children versus through to a spouse or the like. So all that conversation is just really about the engagement piece. And that leads into the typical sort of conversation pieces around control and cost. So, control of self-managed super fund is always a huge positive. When people say, what are the benefits of self-managed super fund? Everyone says control without actually identifying what control is. But control is really a collective of all of the issues that we're talking about today, and that is taxation management, retirement income strategy management, investment management, because still the control issue often will come down to you don't actually have control as to the performance of the assets and all those sorts of things, but it's a far broader piece. And the cost, as I said, this is an area that I wanted to address specifically, because I think the tax office have done a wonderful job here, and I think this will only get better. But we know that a couple of years ago, ASIC released a document that was fairly unflattering towards self-managed super funds and the cost associated with running a fund. I think they approximated that a self-managed super fund would cost about $13,000 a year to run, which of course is a misrepresentation of the truth. And I think the conversation has now changed, and ASIC have also recognised this because of what we've seen from the last 2 financial years from the ATO. And when you identify the key issues from the ATO stats on the screen there, you'll see that there's obviously two standouts that every fund has. Obviously, your supervisory levy at $259, well, that's going to be the same regardless of the size of the fund, but it's a cost that needs to be factored in. And then the SMSF audit fee. So the SMSF audit fee sitting as an average of about $550. That sounds about right from an admin point of view. Those 2 fees are going to apply across the board. Now, what's interesting about these stats? Well, interesting to me, so not necessarily interesting to everybody, but is that the number of funds that were paying an audit fee from this review was 332,000 versus the number of funds included in this review, which was 431. So there's a differential of about 100,000 funds that either haven't paid an audit fee, or from an accounting point of view, the audit fee hasn't been separated from the admin or other expenses. And so we don't have a completely accurate position on these sorts of things, but we do get a fairly good appreciation for where it sits. But I think importantly, when we start to look at the average balance style superannuation fund, that 500 to $1 million being where the majority of funds sit, if we can give that appreciation to people that, the fees are going to be, from a pure management point of view, around about that $3,000 mark. And so it represents on average a percentage of less than 0.5% for funds, then it makes the conversation piece around self-managed super funds more genuine from a fee point of view. And of course, the more complex our funds become, the more expensive they become. And so strategically, if we're looking at adding further members in and then entering into investments with, via related unit trusts or whatever it might be, the costs are going to add up, and we need to be mindful of all of those elements. But I think that there is a genuine conversation there around the cost side of things that we can now actually have with people in this space, and to say, okay, well, what are you paying through your retail fund or through your industry fund? What's your monthly administration fees? What are your investment advisor fees? What sort of percentages are you paying based on the various investment strategies that are being offered to you through that fund? And how can we actually make a genuine comparison to what the self-managed super fund is actually investing in as well? So a more of a like for like option with regards to the various fees. Which then, of course, that takes us into the investment side of things. And I guess the key issues that I would address in a 6-member fund environment here is the 6-member fund does give us greater capacity to pool our assets, so greater purchasing powers. Now, it would be remiss of me to say that there's not been work done in the past that suggests that the more members you get into a fund, actually that kind of becomes a little bit of a diminishing statement, because the decisions become a little bit more indecisive, and more members leads to greater indecision, and therefore less actual diversification from an investment point of view. It does that, but the other thing that it does is having that greater purchasing power also suggests often that we get to a situation where we invest in greater illiquid assets. So we add more members to the fund, and that gives us the capacity to potentially go out and purchase a property. But then there's that whole life cycle issue of, is that property investment beneficial from meeting all of our other requirements, like paying pensions, paying fund expenses, particularly if yields are low, rents are low, and things. And we've seen it all. We've seen it all over the last 2 years. Once COVID and COVID restrictions hit, that it can have a problem. But the other side of that is sort of, and again, all of these things are intrinsically linked, but the other side of that is the benefit payment side. And so the illiquid nature of the assets, we can all be well and good and start planning for retirement and say, okay, we need to make sure that we've got the appropriate liquidity for the point in time where the senior members of the fund start paying a retirement benefit. But what about the other cashing events that might happen, and what else are we exposing ourselves to by adding other generations to the fund? And obviously relationship breakdown is a clear catalyst for that one to be mindful of, in that we might have to look at splitting the assets at some point along the way. And I think these are the considerations that we have to take on board. But if you jump back to the positives of that as well, is it doesn't change the taxation obligations of a superannuation fund by adding accumulation members to retirement members. But what it does do is it provides the opportunity to generate taxation strategies and to almost future-proof the removal of franking credits and things like that, if that ever sort of comes about, by saying, okay, we've got the accumulation members in the fund and their tax liability, or the tax liability associated with the assessable income that they introduce to the fund, is being offset by the credits linked to our retirement income-based assets. Now that becomes a very thorny subject matter, right? And so I put it on the positive side, but it becomes a thorny subject matter when you actually start dealing with families, because what happens is the retiree says, they stole my franking credits. Now, they don't maybe necessarily use those terms, maybe they do, but what they're sort of more interested in is their individual member balance, and they see that they've invested in these shares that are heavily franked, and so that they're expecting that refund, and they're not expecting those credits to be offsetting the tax liability of the accumulating members. And so we have to go back to the whole conversation piece with these funds from establishment, say we are talking about a single tax entity. And so regardless of whether you're incorporating segregation and other things, the tax liability is a one fund strategy. You have to lodge the fund and pay the tax based on the entirety of the entity. So if you want to get really critical about issues like franking credits and that, don't be adding members to the fund who are going to be utilising those credits from an accumulation assessable income point of view. And they're the conversations that we need to be able to have. It's to be able to say, there are good strategies, and there are strategies to be able to offset the tax liabilities, etc., insurance proceeds in that as well. But there will always be some level of detriment associated with it. To get the insurance deduction, you've got to pay the insurance premium, so it's going to impact your cash flow and those other sorts of things. And you might be insuring against an event, which by the time you get to that event, the premiums outweigh the benefit of having it. So all of these things should be factored into the conversation. But from an investment strategy point of view, it comes back to the commentary I was saying before about incorporating younger members into the fund, and whether this adding up to 6. And again, we're not really talking about 6-member funds. We're just talking about making it multi-generational from a fund point of view. My son, I had the thought process after this all came through. I thought, I'm going to go home and have a chat to him about, he's planning on going to university next year. I'm going to have a chat to him about, employment and what he's going to look through from a working point of view, where he sits from a superannuation concept with regards to that. And I got home and he said, "Hey, Dad, I opened up an online crypto account today on my phone." And I said, "Oh, that is awesome, mate. I won't have a conversation with you now about superannuation." Because he went out and he invested the grand total of, I think, $3 into one of these online broking accounts. Last of the big spenders. He was pretty pumped that night when he made a 1 cent return, but he was pretty devastated 2 days later when he'd lost 2 cents. So maybe in reflection, he's the ultimate trustee for me, because if he's worrying about 1 and 2 cent returns, then I know I've got an eagle eye investor looking out for me. But that generational conversation around fund allocations and membership decisions is a relatively sort of critical decision, because it all comes down to the concept that whilst we see that broad brush approach to the SMSF asset allocation in the SMSF space, more broadly, we've got this real focus on SMSF investment strategies and what that actually means from a compliance and administration point of view. And there's no doubt that we all recognise that there is a far greater emphasis, both from an audit point of view and an ATO regulatory point of view, on what an SMSF investment strategy looks like. And old school presenters like myself have to throw out the concept of it's not worth the piece of paper it's written on, because clearly now from a regulatory point of view, it is worth the piece of paper it's written on, but we've just got to write more on that piece of paper. And so we're actually starting to identify and tailor these strategies based around the age of the member, the employment status of the member, the retirement needs of the member. And so then if I'm contemplating bringing my son into the fund, then we have to think about, okay, well, it's not whether cryptos are good or bad. It's if we're going to invest in cryptocurrency or the like inside the superannuation environment, what are the risks associated with that, and address that in the investment strategy, not just say we're going to invest in listed securities, property, cash, and cryptocurrencies, and we're going to do 25%, 25%, 25%, and 25%. That's not a well thought out strategy. We need to identify all the risks associated with those various regulatory elements. And that is the intergenerational issue associated with self-managed super funds and the expansion beyond the original or the traditional spousal based SMSF, and that is that if we're going to bring them in, then there are going to be other considerations, and incorporated into those considerations are obviously the ability to pay benefits, our insurance considerations, and then even more broadly, the retirement income covenant stuff from 2022, and if we sort of see where that's heading at the moment, there's a lot of conversation around, well, that it's a bit too broad almost for self-managed super funds, because our investment strategies have to be far more specific for the retirement needs of each of the member ultimately. And so the broadness of the retirement income covenant, potentially is going to weaken the strength of the investment strategy. So I think there's still a little bit to play out in that space, but all of this is relevant in the entirety of the decision about increasing or enhancing the number of members we have. And so what I want to, I guess, round this up with and talk about for the last few minutes is really the benefit payment side of the whole expansion of self-managed super funds, which really ultimately leads to the estate planning process. So I guess there's a couple of key issues that we need to be mindful of, and that is that it's easy to say that you've got this concept of generational asset transfers, right? It's much easier to say than it is to actually do, because what's happened post 2017 is that there is this absolute need to pay death benefits out upon the death of the member, and so it's arguable that the industry misread the tax law previously, and we started pensions and rolled back to accumulation and did all those sorts of things pre-2017. But now we're in a very clear-cut position of limiting how much we can retain in super when a member passes away. So the key issue I see associated with that is, okay, well, if we're looking at generational asset transfer and we're wanting to retain a specific asset, might be a business property that's linked to a family business that is being passed from one generation to the next, and we want to keep that investment inside the super fund, well, then clearly we start to talk through the strategy of engaging those younger members into the fund earlier so that they can liquidate the fund by making more contributions, but that liquidity is going some way to pay the benefit payments out when a parent passes away or when they wish to start paying a retirement income. But effectively it's a like for like swap. So we're swapping the cash contributions for the asset that's already retained in the fund. Now we can't do that if we don't have that bulky cash component sitting alongside the new members of the fund. We can't retain that property in there, particularly if the property is valued greater than the entirety of the spouse's benefit, and we're limited in what we can do from a transfer balance cap point of view. So that becomes a conversation piece that we need to start a lot earlier than immediately prior to or after the death of a member. And that, I guess, flows into the concept of streamlined estate planning and the strategic considerations. So, the idea of paying out benefits on the death of the member, one of the things that I've argued fairly heavily towards over the last 2 years or 3 years since the super reforms came in is that we've got to always be planning for that final death benefit first, because if we pay the first death benefit out and we start a pension or we roll back accumulation, well, we're still then going to have that second benefit, which is the final benefit that can remain in super. And so the whole concept of looking to effectively plan for the adult children whilst one of the parents is still alive becomes relatively significant in the decision-making point. And will basically mean that we can bring those members in, they can act as a trustee, and then they can be involved in that decision-making process. So, I mean, if anyone's got any questions about all these, any of these issues, please raise them in the Q&A box, because we're going to have a few minutes to be able to go through any questions at the end of the presentation. But those sorts of areas are pretty important for us to start the conversation as early as possible. When you then factor in the negative side of those issues, you get the relationship breakdown side of things. As I said before, if we're bringing younger couples into a parent's fund, and then there is a relationship breakdown, even if the spouse isn't brought into the fund, which of course has its complexities of saying one partner's joining the fund, but we're not allowing you to join because you're not a bloodline relative. That's a different conversation in its entirety. Certainly not one that I would want to be having with too many people. But with relationship breakdown, that then exposes the entirety of the super fund or the assets of the super fund to the process of that breakdown and any detrimental asset sale from a splitting point of view. So all of that needs to be contemplated when we're starting to add generations to the fund. I mean, it's a relatively simple process from a super side point of view, not necessarily from a family courts and legal perspective, when there's a separation of the sole couple that are existing in the fund. When we start to add generations, it can become problematic. And I think all of this comes tied into this one concept of elder abuse that is certainly front of mind for a lot of people at the moment. And that is that, we're talking about financial abuse here and the decision-making process. So one of the key things about that sort of ties all of this issue in together, and if I just sort of bring up this this slide here, is this whole concept of the imbalance of power and voting rights and things like that. And so where does the trust deed sit, and where does the existing membership structure sit with regards to the capacity to make decisions about the payment of benefits? What strength do you have behind whether they're an SMSF will or a binding death benefit nomination or a reversionary pension? Where does all of that sit in regards to the decision-making process when a member passes away? What power does a legal personal representative have? Because a lot of deeds out there won't give the legal personal representative any power, because it doesn't impose a requirement to appoint the LPR on the death of the member. It effectively does nothing more than regurgitate the law, which is use the word can, and so can is not all that empowering for the LPR of the deceased or elderly member. On the flip side of that, obviously from an enduring power point of view, one of the conversations that we're hearing far more in the 6-member fund conversation piece is actually that those older members want to bring their children in to take away that financial burden or that decision-making burden on them as they age. And so they have that trust and that relationship with these younger family members to come in and assist them, generally via an EPOA, to make the decisions on behalf of the fund. So, it's a fine balancing act between who's going to do right and who's going to do wrong. And we've seen who's going to do wrong through the history of estate planning and the cases that have come before us. That's not going to go away. But of course, the capacity for us to monitor that and address it up front with the decision about who to admit to a fund becomes relatively important. And all those other issues, which I sort of highlighted through the previous slide about pension accumulation interest, multiple pensions, those things help us to achieve estate planning objectives using lump sums and recontribution strategies. But again, the sooner we can engage all the parties to the decision process, the better off we're going to be. So, I think when we look at the issues associated with all of this, the generational change is clearly a key one. And I think this is one that the industry has got a little bit of catching up to do with regards to self-managed superannuation funds. And that is just like the conversation between my son and myself the other day about the crypto account. I'm all for him experimenting with what he wants to do, but the way he does things versus the way I do things are very different. And how do we address that if we're going to join the same fund? Are we running our fund from an app? Are we running it, on an Excel spreadsheet? Are we running it on a piece of paper? That generational change is a real impact issue. Trustee education is clearly an area that we need to be mindful of, and people like myself have been banging on about that for quite a long time. But understanding your obligations as a trustee and then sharing that education with others is critical. Clearly, poor advice becomes a situation here, and the advice piece is really front of mind with groups like the SMSF Association and that at the moment, and where we actually sit. Because if we're talking about a family fund, then we are talking about this whole concept of it being infinite from a lifespan point of view. It can pass from generation to generation, and yes, benefits have to be paid out, but we've got the capacity to keep this one structure with the one company as an ongoing entity for quite a significant period of time. So we want to make sure that we dot our I's and cross our T's in that regard. So look, that's the overview of the 6-member fund, or the introduction of more members to super, that I wanted to bring about for you all. If anybody's got any questions, as I said, just chuck them in the Q&A box. And I will attempt to answer them, or if we've got any scenarios. For anyone in Adelaide that hasn't seen it, we've got a pension workshop next week. We're hopeful, very hopeful, obviously, that circumstances in South Australia don't change, and that will go ahead. But I'm looking forward to getting face to face with people and running through for a few hours a whole heap of pension strategies and considerations in that pension environment. So look, I have got a question. Let me read that one out. So one of our clients has 3 individual trustees, mum, dad, and mother-in-law. Okay, they have sent through a signed minute confirming they've now admitted their 3 kids, all minors, as members, along with signed membership forms approved by the parents as legal guardians. Excellent. The minute confirms that because the kids are minors, they are not required to be trustee of the fund. Correct. Is there anything else you would want to see from administration or administrator perspective, noting the deed allows for 6 members as it refers to 17A? Am I correct that once the eldest turns 18 and the fund needs to make them an individual trustee or a corporate trustee should be adopted? Anna, that's a great question. And so let me finish off by answering that one. So you've done all the right things from a resolution point of view, I suspect, at this point in time. Of course, the other key thing is to do your change of details form with the ATO to admit the members, where they will just be signed off as being admitted. Now, the ATO process can get a bit wonky in these sorts of places because the parents are already trustees of the fund. So you can't go and reappoint them as trustee. So you would just add the children as members. It may create some sort of exception reporting inside the tax office, just to be mindful of to deal with that situation. We often get calls around EPOAs and that, where the ATO are just confirming what the structure is. But having those resolutions in place is the appropriate step. You're absolutely spot on. Then once that first child turns 18, then they need to be added as a trustee of the fund. Now, that's where the problems start to arise, because if we go through the association, that let's assume that there's 2 years gap between the 3 kids, could be shorter, could be longer, then you're having to go through that process every couple of years to add the new trustee and then to amend the asset holdings of the fund. So the concept there of moving to a corporate trustee and making them directors once that first child turns 18, if not before, is certainly a worthwhile consideration, because it's just going to make the administration beyond that first member turning 18 or that first child turning 18 a lot easier. So I think that's a great question from a practical sense, and I think it's all about trying to make the process as simple as soon as you can in the engagement of bringing those kids into the fund. But putting the resolution in place is most definitely the right first step to take. So thank you for that question. Thank you all for attending. As I said, if you want to find out anything about the workshop, jump online to our website. Otherwise, I look forward to catching up with you all next month when I speak a little bit more about the non-arm's length expenditure stuff. Now that we've had a final position from the ATO, which impacts a lot of things around contributions and other issues as well. So thanks for attending, and I look forward to seeing you all next month. Thank you.